Everybody, Ron Phillips here. I want to talk to you today about return on investment, specifically real estate-based return on investment. All right, because a lot of you understand mutual funds and stocks and bonds. Well, maybe you don't understand, but you understand that your return's never as high as they tell you it's going to be, and there's really only one, maybe two on the outside, right? So you can get capital growth from a stock. And you can also get a stock that doesn't do a whole lot of growth, but it does produce a dividend, right? So there's dividend stocks, which is cash flow, and then there's capital growth stocks. Capital growth stocks are mostly it's what we in real estate would call appreciation. Okay, it's a gain. Well, in real estate, one of the coolest things about real estate is that there are 4 returns that you get on every single property. And so let's just go through them really quickly, and let's use this property. Property price is just a little over $160,000. Okay, we're going to put $32,180 down on this property, so we're going to leverage into it. Okay, and then with real estate, the first thing you always think about is cash flow. So we're going to put a tenant in there. After all of our expenses, we're going to be left with a cash flow number. Okay, unless you're breaking the rules, which you shouldn't be. Okay. So the first one is our cash return on investment. In this particular property, we have $4,605 per year after all of your expenses. So after you pay your manager, your principal, taxes, insurance, anything else you've got to pay on the property. After that, you're left with $4,600, okay? Pretty good investment. That's a 14.3% return. And the way you calculate that is you just divide 4,600 into 32,000, and what that does is it gives you a percentage. Percentage in this case is 14.3. Now that's an incredible return all by itself, okay? But we're not done yet. So we have the cash flow, but in addition to that, the government gives us a gift, and they allow us to depreciate the structure off of our taxes. You get to do that over 27.5 years. And I'm not going to go into exactly how that's figured, but on this particular property, after you calculate the depreciation and you calculate on this one, we used a 25% tax bracket. After you do all that, you get an extra $1,168 that you get to take off of your taxes. All right. Now, not everybody can take that. If you make too much money, they start to cut it back. And again, I don't have enough time in this video to cover all of that, but if you get to take this, it's worth another 3.6% in return, because 1,168 divided into 32,180 gives you a percentage, 3.6. You add those two together, already we're at 17, almost 18%. Okay. Well, the next one is a pretty neat one too, and it's one that a lot of people forget. You see, you have a tenant in your property. Every month they pay money. And that money goes to pay your principal and interest payment. Okay, so every month you're paying principal, but it's not coming out of your pocket, it's coming out of the tenant's pocket. So they are in effect reducing your mortgage over time. And that is a real return, because as they reduce your mortgage, it creates equity in that property for you. Okay, and that's a return as well. Really neat thing about this is the longer you own the property, the more every single year, because on an amortization schedule, the more principal you pay is the further that you have the loan. So in the first year on this property, it's $1,892. You divide that into 32,000, you get by 32,000, you get 5.9%. Okay? Now that is a fantastic return all by itself when you compare it to all the other different ways that you can invest your money nowadays, okay? But when you start to combine that with cash flow and combine that with the tax incentives, it's incredible, okay? And then the last one, again, this one is a little bit, it depends on the year, it depends on what the market conditions are doing, but this one is really powerful. And the reason it's really powerful is because appreciation, this is a $160,000 house, so 1% of that is $1,600, okay? So $1,600 worth of appreciation is going to fall right in between here. We're going to be somewhere around 4 to 4.5% on a return for every 1% of appreciation that happens. Now, that's pretty cool. We used, I think we used 5% appreciation on this one, and 5% gives you a 23.5% return. But even 1% gives you another 4 to 4.5%. 2% is going to give you 8 to 9, and you can see how this works, right? You don't have to have a huge appreciation to get a massive return because you're leveraged into this property. And that works on every single one of these, okay? But when you add all of these up, the numbers start to become staggering. They actually start to become not believable. And the only way for you to actually understand and believe them is to experience it. Now, math doesn't lie. If you get $4,600 a year, that's a 14% return. It just is what it is. But most people, when they look at properties, they only look at the one, when they should be looking at all four. Internal rate of return on real estate is ridiculous when you actually figure in all of the different ways that you make money. And that's one of the main reasons that so many people like me really, really love real estate as an investment tool. All right? I hope you've learned a little bit more about return on investment and why we've chosen real estate as the vehicle to help most people retire. And if you have any other questions about this or how this works, feel free to give our office a call. We're here for you and we're happy to help you out.